Common advice leads to common results. We all like to follow the successful people. We always like to hear what they're saying. But unfortunately, very often people say different things to what they've done themselves. Let's have a look at Warren Buffett's investment advice, one of the most successful investors of all time. Let's have a look at what he is recommending most people should be doing.
I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin. Because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
At the annual meeting for Berkshire Hathaway this year, you introduced a special guest to the audience of 40,000 shareholders who were watching. It was Jack Bogle. Why did you want to recognize Jack Bogle?
I think Jack Bogle has done more for American investors than any other person connected with Wall Street or the investment process, because he, with a number of other people, he came up with the idea of the index fund. He wasn't the sole thinker behind it, but he was the guy that implemented it and crusaded for it. But now there's trillions of dollars in low-cost index funds. Those people are going to have better lives. They're going to have better retirements. Their kids are going to inherit more money because of Jack Bogle and his efforts.
Now, Warren Buffett is one of the most successful investors of all time. Over here, we see the chart of Berkshire Hathaway. That's the company he acquired and then turned into his investment firm together with Charlie Munger. And the stock went from a bit over $200 in 1979 all the way to $620,000. Here we've got the S&P 500 during the same period. So how did Berkshire Hathaway perform relatively speaking? That can be found in this chart. So this is now the Berkshire Hathaway stock divided by the S&P 500. Initially, the outperformance was massive, more than 4,000% in those 25 years roughly. But in the last 20 years, the alpha wasn't that big anymore. And there's probably two effects here at play. The first effect is that Berkshire Hathaway simply has now so much capital, so it's much harder to double the capital now compared to when there were just a few millions in the fund. The second effect, though, might be that stock investing is now way more competitive than it was back in the day. So market participants always learn more and more over time, right? And if you have an edge at the beginning because you learned the most, then that edge might diminish over time as other people catch up. So pricing over time might become more efficient. And so here is why Warren Buffett recommends to buy, say, the S&P 500 in a low-cost form. Over time, prices simply tend to go up. Sometimes we crash. That can be 50% even. But if we endure during those crashes, we tend to go up. This vertical line here, by the way, is when Bitcoin started during the global financial crisis. But here's the problem. The reason why prices are going up is not just because America is getting more productive. The reason why prices go up is mainly because the money supply is growing. So that's what we're seeing over here. This is USM2, money printer go burr. And so here's the chart that's actually important. This is the S&P 500 divided by the US money supply. And of course, we do have our crashes here, but the main important thing is that long term, we don't necessarily see that much growth. The reason why Berkshire Hathaway stock is higher today than 10 or 20 years ago is not the great stock picking abilities of Warren Buffett, it's simply the expanding money supply. So by buying the S&P 500 every month, we are not necessarily making money, we're not necessarily making purchasing power, we're simply just fighting monetary debasement. And here's the problem. We looked at the S&P 500 and that's already one of the best performing stock markets in the entire world. If we take another stock market, let's say from Hong Kong, or let's say from Europe or from the UK, whatever it is, we tend to see underperformance versus the monetary debasement. The reason why Warren Buffett is so rich is not because he invested in the S&P 500. He's so rich because he was very, very good at stock picking in the early days. He was able to beat the market, and he was also able to keep that capital as the edge, as the alpha declines. So the S&P 500 doesn't beat monetary expansion. And so let's see what Warren Buffett is doing, not what he's saying. Have a look at the constituents of Berkshire Hathaway. 40% of the entire net worth is in Apple stock. That's a highly, highly concentrated portfolio. And here's probably one of the reasons why he's doing that. What we've got over here is the NASDAQ 100, so the top 100 technology stocks in the US. The vertical line is again the creation of Bitcoin, and over the long term, of course, this is going up. We've got the .com bubble here as well. So this is where the NASDAQ went down by more than 80%. But in the end, the S&P 500 and the NASDAQ doesn't really look that different long term. But yeah, remember, this is the S&P 500 divided by the money supply, not much growth over the decades. What we've got over here though is the NASDAQ 100 divided by USM2, so by the money supply. This actually went up very nicely. So by taking on more risk, by investing in a sector that can scale very easily, that has very high margins, we can actually beat the average. So saving in the S&P 500 does not cut it. Saving in the NASDAQ 100 though does. And so have a look at this. This is Apple divided by the NASDAQ 100. There are our ups and downs, but within the NASDAQ, Apple is an outperformer. And this is an effect we see pretty much across all asset classes. So we see this in stocks, we also see this in crypto, we see this in property. Most of the monetary gains are concentrated in just a few players. The reason to diversify, to buy the entire index, is not to have broad exposure, it's not to reduce risk, it's simply to also have exposure to the one winner that pretty much takes all the profit. If you randomly pick a stock in the NASDAQ 100, chances are that you will pick a loser because most stocks underperform, only a few stocks take all the profit. And so that's how we can escape. This is the NASDAQ relative to the S&P 500. It tends to outperform if there is no massive bubble. If you're investing in stocks for retirement and if you're planning to hold over many decades, I believe having a strong tech focus makes a lot of sense. Have a look at this. This is Berkshire Hathaway stock relative to the NASDAQ 100. It's very unclear whether or not we have consistent outperformance here. This is Berkshire Hathaway stock relative to Apple. So you don't need to be a genius in investing. You don't need to know all the complex models that Warren Buffett uses if you simply just pick the technology that will get adopted. When you're buying the S&P 500, a lot of your capital will do worse than monetary expansion. If you're buying the top 100 technology stocks though, so the NASDAQ 100, you've got a chance at beating the market. If you're even able to somewhat identify who the winners might be, and you can maybe cut out half of the stocks in the S&P 500, then you're likely going to even outperform that. So you don't have to necessarily bet on Apple, but if you can see stocks that are doing very, very poorly within the NASDAQ 100, why also own those? Again, most profit is concentrated in the hands of just a few companies. Warren Buffett is heavy in stocks. Watch what he's doing. Don't necessarily watch what he's saying on television. This is not how he made money, and that's very unlikely the way how you will make outperformance. You can't just swim with the average. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. If you've got Telegram, feel free to join us. Link is down below.